whenever I hear, clients talk about, their advisors that told them, oh, this portfolio is designed to get you 6 to 8% return. Mm-hmm. It's not. No, it's not. Nobody knows. No one knows what kind of returns you're going to get because no one knows what the market's going to do.
What really did it for me was the symposium that you and I went to, which we talked about, that said, hey, midterm elections, historically not good. I got to look back at history and say they tend to be volatile. People don't know what's going to happen. That being said, that same symposium said the year after a midterm election historically is a very, very good year. So my thought is, what a great time to keep buying, because I want to get in before the big upturn that I think is going to happen next year. So that's kind of my thought.
Welcome back to another edition of the Retirement Planning Happy Hour. Eric, Douglas, Chris Vaughn with Family Wealth Planning Partners, and we have a few things to discuss. Kind of off the top of our head here, you can see where we have a new background.
The backdrop's a little different.
Backdrop's a little bit different. That's because we have completed our move into our new space. Well, actually, I shouldn't say we've completed.
I was about to say completed is probably not the right word.
It is still very much in process, right?
We have physically moved, but complete is that's a stretch, right?
Yeah, so you can see some of the walls are still a tad empty, which will be rectified here in the near future. But
the table is not right.
Exactly. So when you're relying on contractors and designers and all these other things right around the holidays, sometimes things can tend to get delayed.
And not just to throw the contractors under the bus, because we'll do that too. If you look at the glassware that we're using the coffee mugs because that's the only thing we can find right now. Everything else is in a box somewhere in this office. So everything's going to look a little bit different for a little while.
Yep. So, but that's okay. We're super excited about the new office. We, as soon as we get a little bit closer to completion, we will do probably another video tour or something that we'll put on the YouTube channel, just to kind of show off the space a little bit, because we are going to be very, very proud of it. We already are very proud of it, but once it's 100% complete, it's going to look really, really nice, and we're super happy about it. So that'll be, we'll have some other topics of conversation on the podcast here over the next couple of months, because we're also in the process of finishing up some rebranding. So we're going to be some new logos.
Lots of new stuff to see,
some new slogans and all kinds of new stuff for our website that we'll be introducing to all of our clients and prospects and all of our followers here on social media. That number is growing a little bit every year. So when we look at where we were at the beginning of the year versus where we are now, it's for us anyway a pretty good growth rate.
That's actually a pretty good lead into our topic today, but we haven't talked about bourbon yet. So
no, we have not introduced the bourbon yet.
Go ahead and
so
talk
I
about
will go ahead. Well, first let's talk about the topic. Yes, because the topic is, you're going to see a lot of this topic for a lot of the different financial industry podcasts, right? This is a fairly common topic that you see, but it's really fun to do because what it does is it highlights, and we talk about this all the time on the show, that nobody knows anything, okay? Nobody knows anything. Nobody knows what they're talking about. And what do I mean by that is specifically as it relates to market predictions.
Yeah. So let's be clear. We're recording this episode roughly 1 week into January. So it's the beginning of the year, and the predictions that people roll in this time of year, they love to talk about what the markets are going to do.
Exactly. Right? And so we're going to go back and review what the predictions were at the beginning of 2025. And when I say predictions, I'm not talking about, average Joe and Judy Smith from across the street, right? I'm talking about the biggest investment banks and financial advisory firms in the country, basically the firms you're going to find on Wall Street, and what their predictions were in 2025, and we'll see how right or wrong that they were. And we also have the updated predictions as well. So a lot of those same
for
companies.
2026, right?
Exactly.
Let's see how they do.
Exactly. So we'll definitely that'll be our topic for today. But go ahead and introduce the bourbon, because
so let's talk bourbon first. Unique for us. I have something different today. So what you are looking at is a bottle of Maker's Mark Cask Strength. That is what is in the bottle, but it has been removed from the bottle, and we did some secondary aging with it. So a group of buddies that I like to run around with, we call ourselves Group Therapy. And you can just imagine, right? So we get together, we drink bourbon and some craft beer and stuff like that every week or two. And one of the experiments that we did, we bought a 5-liter charred new barrel. So 5 liter, that's fairly small.
Yep.
We did some aging with some other whiskeys in it. Left that for, 6 months or whatever. We emptied that out, and then we took however many bottles of Maker's Mark cask strength it took to fill that barrel up again. And it's been aging for, I believe, about 8 months. So it has been in an exterior environment. Although it's sheltered from the weather, it's still exposed to temperature changes, things like that. And then we took it all out and put them back in the original bottles. So it is still Maker's Mark cask strength, but it's basically a double oak version, if you will. I will tell you the original proof was at 111. We did test this out. It is now 112, so very, very little change. But that is what we are drinking today. This is something different, something if you want to have a little fun, you can experiment around with bourbon, and you might come up with something that you really like. So that's our bourbon today.
It was like those little small bourbon barrels.
That's
that you put in,
exactly
like,
what
your
it
home
is.
bar?
Yeah, it's we bought it from Buffalo Trace.
Okay.
So it's even got their logo on it, and we put Maker's Mark in it because
I think I knew the guy that started that. Or
there's some really cool things out there that you can do, and I would encourage you, if you are a bourbon guy, experiment around, try some different things. You never know what you might like.
Yeah, well, it's fun to do it at home, right?
That's
it
exactly
yourself.
right.
DIY kit.
DIY
right?
kits. There you go.
So that's fun. So yeah, we'll come back and review the bourbon here at the end. So let's talk market predictions. Once again, I just want to set this up a little bit because we talk about this all the time. Whenever you go on TV and you see these people on the news and you see these prognosticators talking about what the market's going to do on a daily basis and what the market's going to do over the course of a year, more often than not to say that they're all wrong, but they're never fully right?
Sure.
Very, very, very rarely anyway. Most of these people, these predictions, especially when you're getting them on TV or consuming any of this information via any type of a media out there, they don't care if they're right or wrong. They're trying to get you to watch. Right? That's the idea. They're selling
and if you
ads.
watched, it worked.
Yeah, and so it doesn't matter how right or wrong these companies are. They're just it's content, right? And that's what, and quite frankly, that's what we're doing, right? We're talking about this and we're using this as an example of how right or wrong a lot of these companies were. But for us, it's content, right? But it's an opportunity for us to talk about the market and for us to educate our clients and our listeners, which we love to take the opportunity to do. But I just want to preface that again by saying that these people that position themselves as industry experts are not necessarily that much smarter, or at least as it relates to their predictions for what's going to happen next in the market. Right. They may be the smartest people in the world when it comes to markets, when it comes to investments and all the different products and funds that are available out there. And there is a lot of information to consume. There's a lot to know. And so these are really, really, really smart people. The point of all this is to show how wrong that they can be.
Right.
Because nobody knows.
Correct.
The market is an entity unto itself. It is so massive, it is so huge, and it is influenced by so many different things that nobody has any control over, and no one can predict the things that are going to happen in the upcoming year. That might have any type of an effect on the market,
right.
and what the performance is going to be. So as we look back at 2025, what would you say the biggest driver of market returns was? Or actually, let me rephrase that.
So that might be the most obvious question ever.
What was the biggest story in 2025?
The biggest story in 2025 relating to the markets has got to be the Magnificent Seven. And that's been true for the last couple of years. You've got these companies that are driving the markets up big time. And then you couple that with what I would consider to be the other biggest story. Their co-big stories would be tariffs. The whole tariff thing was a huge issue in the markets last year, both positively and negatively.
Yeah, and the reason I went to tariffs immediately as far as being the biggest story of 2025, because at the beginning of the year, when all of these predictions were made, nobody saw that coming.
Right.
Nobody had any idea that tariffs were on the table. Maybe some people in Washington did, but they weren't really a thing. No one knew that Liberation Day was going to be a thing. As we go back and think about that day back in, what was it, early April?
Trump was out April there 9th or something like that. Yeah,
it was a windy day. The hair was blowing. He had that little cardboard cutout of all the tariffs, and it kept blowing in the wind. And it was a disaster of a rollout, right? And the markets responded accordingly because no one knew what the hell was going on.
They bombed. That's exactly right.
Exactly. And the markets just absolutely tanked. But nobody could have predicted that day. Nobody could have predicted the whole tariff announcement and of course what the expectations of the tariffs were going to be never really occurred.
Right.
It ended up being, to be quite frankly, a nothing burger, at least as far as the markets were concerned. You can make another
over time, right? They did tank there for a while, but they recovered, and to
fairly
your point,
quickly.
yeah, it was almost that V-shaped recovery like we had back in 2020. It was very similar.
Yeah, and to be clear, at least the effect that it's had on the stock market up to this point, knock on wood, has been mostly a nothing burger.
Yeah.
Now, I could argue the effect that it's had on mom and pop shops has been quite a bit different. So the smaller companies that are private might be dramatically more affected by tariffs just because they don't make as much money.
Right.
But we're not
when
talking
we say
about
the
that.
markets, we're typically talking about the S&P 500. So you're talking about big players now. The in theory, the 500 biggest companies in the U.S. Those are not going to be as dramatically impacted by the tariffs as the small mom and pops that you're talking about.
So let's set this up. What did the market finish in 2025?
Let's see.
And when we say the market, we're going to talk only about the S&P 500 because we could have this exact same conversation about the Dow Jones Industrial Average, about the NASDAQ, about the Russell Value Index, about any of these, right?
Right.
So we'll just stick with the
We're
most
talking
common.
everything is S&P 500 for the rest of this episode. So the close on December 30th, which was the last business day, was 6896.24. So 6896 was our closing number.
That was up just under 18%, so 17.9% returns for the entirety of 2025.
Right.
Now, you mentioned the Magnificent Seven. We're not going to break down how the S&P 500 arrived at that return number, right? We're not going to break down where it came from. Just the market itself, the S&P 500, that's what it returned, was just a hair under 18% for the year. So let's look at who came relatively close.
Well, okay. Before we do that, let's remember what the traditional average is for the S&P 500. So it depends on the time frame that you look at, but it's usually really high 9% to around 10%. That's average. So if you do better than 10%, it's an above average year. If you do worse than that, it's a below average year. So 17, 18%, that's a banner year when you think about it. That's a really,
year.
really
It's
good
a
year.
Yeah. It's a great year. And coming off the heels of 23 and 24 that were also
fantastic years, right?
So
all right. So we want to start with who came closest. Is that where we want to start?
Well, we'll start with So who came closest was the one who had the highest prediction.
Yep.
Right. So that was actually Oppenheimer Asset Management. So they were expecting an 18.4% return for the S&P 500.
Pretty close.
So they were a little more bullish than what the market actually returned. But they were the only company out of this entire list. And I'm going to hold this list up, and you should be seeing it on the screen here as well.
This is not every single company out there, but this is just some of the big players that we found.
We've got over 25 firms listed on this, and they were the only company to predict over and above what the market actually returned, and they were actually the closest as well with their prediction at 18.4 versus an actual return of 17.9. So to me, that was really, really interesting. Coming into the year, I can't tell you necessarily why everyone was maybe a little more bearish coming into 2025, but that seemed to be the sentiment. Most of these firms were definitely expecting closer to average returns. They definitely were not expecting across the board the returns that we got.
Right. Because
I think they were probably expecting a little bit of a cool off from the years that we had in 23 and 24.
Well, we did have a couple of banner years, and usually, you're going to have to pay that back a little bit. You're going to correct so that you don't get too much of a bubble. You're absolutely right. I would still say on this list, though, we're looking at 25 different companies that are on this list. More than half of them are above average returns is what they're predicting, although very few of them are up in the 16, 17% range or higher.
But let's pick out some names from the bottom, right? Some names that are quite big. So we had Oppenheimer and Wells Fargo. Those were the two that were the closest. And those are obviously two huge investment banks. But towards the bottom of this list, Raymond James, that's another firm that pretty much everyone's going to have a familiarity with.
Right.
They were predicting 5.9% return in the S&P 500. Citibank, 8.4. JP Morgan, 8.4. Goldman Sachs, 8.4. Morgan Stanley, 8.4. Not a lot.
Seems to be
variance,
a trend here.
Not a lot of variance between those other major investment shops that you're going to find on Wall Street, which is actually going to lead me into another point here in just a moment. But But once again, all of those names that I just said are names that you're very, very familiar with.
Mm-hmm.
Everyone, I did not say a name that nobody listening to this podcast has probably not already heard.
No, you've heard of all of them.
All of their life. These are the biggest shops out there, the biggest names. Everyone's very, very familiar with who they are and what they do. And so you would expect, because they do employ probably the smartest people on Wall Street.
Sure.
I know for a fact that they do, right? They were all wrong.
They weren't wrong. Just a little wrong. They were big time wrong.
They were wrong 9-10%
yeah.
on all of their predictions. And the people that you expect to be the smartest people in the room when it comes to these things were all completely off.
Yeah.
Okay. What would be an interesting exercise, and I did not take the time to do this, was after Liberation Day. All of these firms came in and revised their estimates.
Oh, yes, they did.
Okay. So, the revised estimates for the S&P 500 at the end of the year, every single one of these firms after Liberation Day revised their estimates down from what these numbers are here.
Right. Because they saw that trend line just drop off a cliff after Liberation Day.
And they got spooked by Liberation Day, and they thought that it was going to carry into the end of the year. Mm-hmm. And then guess what happened at the beginning of the fourth quarter? All of these firms started revising up their estimates.
They knew they were wrong, right?
Yeah, they were revising their revisions, right? Because they had revised downwards so much that the market had so completely outperformed that their revisions that they had to revise again. So I did not go back and do all of that research, but I was noting that throughout the year, all these investment shops that were revising their estimates. Yeah. So that should have been probably in addition to this exercise, but for what we're talking about, this is perfectly fine, right? But all these big firms, UBS is another one. 10.1% was what they were expecting. Bank of America, 11.2%. Carson Group, they're one of the biggest RIA firms. They were actually closer. They were expecting about a 15% return. So it's just interesting to me. But going back to the comment that I was going to make, in regards to all of these major investment shops and how close the numbers are,
right,
for each one of these firms. Very, very rarely do you see an Oppenheimer or a Wells Fargo that were so far and above, so different than what kind of the consensus was on Wall Street. Because it's interesting because you can be wrong if everyone else is wrong. But very, very rarely do you see firms kind of put themselves out there and provide the outlier, right? You don't see very many
because
firms.
If they're wrong, they lose credibility.
Exactly. Right. It's okay if everyone is wrong. You're okay. You were with the crowd. That's what we all fight. It was conventional wisdom, and you hear me talk about conventional wisdom all the time on this podcast and how stupid it is, right? But
tell us what you really think.
Yeah, exactly. But it's just interesting to me how closely aligned so many of these predictions were, because no one really wanted to go. Well, I say no one. Very, very few firms really wanted to go out on a limb and really take that next step of showing you what they really, really thought and being a little bit different from what most of the other firms were predicting.
Well, and to your point, of the 25 that we've got here on our list, I'm looking at the bottom 15 with a couple of outliers on the very bottom. The Raymond James is way down there. You've got a spread of about 3%.
Yeah.
Right? These are, to your point, this is the conventional wisdom where, they're all pretty much in that same window. And then you've got another handful that are just a little bit better than that. And then you get to that handful that are up at the top that are predicting something more grand. And to your point, if they're wrong, they lose credibility. So they got to be willing to go out there.
For sure. So I don't know if you have any other major takeaways.
The biggest takeaway that I've got here is that very clearly these are crystal ball forecasts. It's a little bit more scientific than that, but not much. So don't lose a lot of sleep about whether the market is forecast to be way up or way down. I mean, there's so many things. It was interesting you were talking about how many revisions that they had to do, because you had a couple of different events that happened this past calendar year that had some pretty dramatic impacts on the market, in the short term at least. And those can't necessarily be forecast, right? What's in the news right now is the issue in Venezuela.
Yeah.
We could not have predicted that 30 days ago.
You couldn't have predicted it 30 minutes before it happened.
Yeah. Which is kind of the point of that. You couldn't have predicted that with some level of accuracy. But if you think that that's not going to impact the overall markets, you're kind of naive, because the oil itself is an energy issue. You know what? All of the companies in the S&P 500 use energy at some level. So it is going to have an impact. We just don't know what it's going to be.
Well, the next one's Greenland, right? We're talking about Greenland again.
And that's in the news again, too.
We started 2025 talking about the annexation of Greenland, and now that's back on the table after Venezuela. That one's been teased, so that would be interesting to see for sure. Although that one, I think, is coming at it from more of a national security issue. Although Venezuela, I suppose, was as well. But you can argue how much of it was national security. You could argue
both of those were national security. And even if you are 100% correct, and that was the only motivation, which of course there's more than one motivation, even if that was the only motivation, it's still going to have an economic impact. And that's just the way the world works, right? These things are all intertwined with each other.
So anyway, that's certainly interesting to see, and who knows what world events will pop up in 2026, and there's no way for us to know.
I know one thing, you will not be able to accurately predict what they are.
Nope.
That's the one thing I know we're going to get right, is that we won't be right.
And actually, I will tell you one thing that will cause volatility probably is going to be we're in a midterm election year.
Absolutely true.
So when you look at, and we did an episode on this not too terribly long ago.
Yep, I think we did that 3-4 weeks ago.
One of the takeaways though was the performance of the stock market in midterm elections year. In midterm election years tends to be the poorest.
Yep.
You kind of lose that initial bounce of year one of a new presidency and a new administration, and the honeymoon phase is maybe worn off a little bit. Right, we're into the second year, and the entire year is basically about trying to change the administration, or at least change a lot of the representatives. And there's a lot of promises made and a lot of things kind of happening. And
go ahead and say it. There's a lot of lies told during those elections.
Well, you get lies every year coming out of D.C. That doesn't matter what year it is. So, but that's going to create some additional volatility too. Now, how that interplays with any other world events or any other market events that occurs. Who knows? We'll find out. We don't. But that's the point of this entire exercise, is we don't know, and neither do they.
So with that in mind, let's talk about what they do think, what they're willing to stick their necks out in some cases, is going to happen in 2026.
For sure. So a couple interesting.
I'm seeing the same names in the same parts of this scale. That's
there's a couple exceptions, but number one, Oppenheimer is still going to be the most bullish out of the firms out of the investment shops that are listed. So Oppenheimer is still number one on the list as far as what they predict the market to return next year.
And I
should say this year.
Now they've picked a year-end value, and then they've calculated what the percentage change is. But I can't help but notice. All right, it's 2026. Which is the 250th anniversary of the signing of the Declaration of Independence, and therefore the 250th anniversary of the United States. And their percentage change for this year is 17.76. I can't help but notice that. Surely that was an accident, but it's kind of cool. Yeah. I do kind of like that. What are the odds, right?
That is pretty good, yeah. But yeah, Oppenheimer's come in at number one again, 2 years in a row. They are predicting, out of all the investment shops listed, they are predicting the highest returns in the market at just under 18%.
And let's be real honest, again, they were the most accurate of the people that are of the groups that are on our list from last year. Let's really hope that they're the most accurate this year. I would love to have the better part of 18% this year. That'd be fantastic.
So Deutsche Bank, that they're listed at number 2. They're expecting about 16.3. Their 2025 predictions were 16.7. So they're kind of right in line with what they were, similar to Oppenheimer. Then we're dropping. What's interesting now we're getting into Morgan Stanley.
Right,
so
that one's interesting.
Morgan Stanley was significantly less bullish than the other two coming into 2025.
Right.
They're significantly more bullish heading into 2026, and they're expecting a 13.4%.
So they're not going out on a limb like Oppenheimer is, but they're certainly going out on a limb based on what they did the previous year at 8.4. They were down at the bottom of that list. So very interesting.
Yep. UBS, RBC, those two are next. They were predicting basically 10% returns in 2025. They're a little bit above that. They're at 11 and 12% basically for 26. Then here's some other big names. Citigroup, 11.9. Goldman, 10.4. JP Morgan, 9%, right around the average, just a hair under the average, right? Now you're getting into the ones that are maybe divergent from the rest of them here at the bottom. And these are probably the most interesting. But Bank of America, for sure, is probably the least bullish, the most bearish, if you will. 3.2 is what they're expecting. Ned Davis Research, they do a ton of research in the industry. The average consumer might not know who they are, but in our industry, they're a pretty big deal. They're also expecting a little bit more of a, I don't want to call it bearish because it's not negative, right? But they're definitely expecting more of a flat year at 3.2% returns. So it's interesting because we have everything from 3 to 17. We don't have any negative.
No, there are no negatives on here. That is a positive.
But is it?
I don't know. So, well, that goes back to the podcast that we did that you just referenced a minute ago. In midterm years, you tend to have lower years. Now, that doesn't mean that they are negative years, but they tend to be lower years. And this group that we see in the bottom 5, now we've only got 20 firms in our predictions for 2026.
And there's certainly some firms that we don't have on here.
There's 10 of the 20 are predicting at or below historical average, and most of them are below. So it's about half. Well, okay, it's an average, right? So that actually worked out well. I find it interesting, the ones that are down towards the bottom, because if you look at that, reference that podcast we did on midterm election years tended being low, right? They're usually positive, but not by much. Those numbers are actually more in line with what the historical average is in midterm years.
So who knows? We'll see. But it's just, I think it would be interesting because no one really stuck their neck out and went negative on their prediction.
Nobody did, right? This is not on this list anyway.
This is going back to the point that I was making. It's really, really hard right now, after 3 consecutive years of a really good market, to put your neck out on the line and say, I'm predicting something different.
Right.
Especially after the way that the market rebounded from tariffs, the way that it's rebounded from all this AI bubble talk, and we've been beating this AI bubble to death over the last couple of years. And there are still some people out there that are really trying to beat it. But I think a lot of the concerns, a lot of the predictions of this major market crash because of this AI bubble that's going to explode haven't materialized yet. And I think more and more people are starting to realize it probably won't. Yeah. I don't really see a market crash because of an AI bubble that's going to explode. When you look at the AI companies that are making the most money, they are making they are making money, right? And the
well, it's not fair to compare, to your point. I've heard the comparison. We've talked about this before. This AI bubble is like the .com bubble.
It's nothing like it.
It's nothing like it, but I've heard people say that so many times. The .com bubble existed because of the belief or the hope, if you will, of all of these companies who had never produced a profit. And that went on for the latter half of the 90s. All of those companies, we started figuring out, hey, they're not going to make money. They're betting everything on this new technology called the internet, and it didn't pan out for a lot of them. Now, some of them did quite well, and those names are still very much part of it. But the reason that bubble burst was because these companies were basing their future and the valuation of their companies on profits that had never happened yet. That's not the case now. The Mag 7, for example, that have been the big drivers, and a lot of that is AI-based. These companies are all very profitable. They have a product, they have a service that is in demand. They are making money. So this is not the same thing.
Very valuable products that are very demand heavy, right?
Yeah, exactly.
And I know there's a lot of people that would probably love to see some of these Magnificent 7 companies and those other AI companies maybe come crashing down to earth. And it's just, I don't see it happening. At least some companies will, but it's not going to happen in mass. Yeah. At least that's not what I'm thinking anyway. That's not what I'm seeing. But clearly, most of these other strategists are not seeing the same thing either. Or at least if they are seeing it, they're keeping their they're keeping their mouth shut about it,
keeping it close to the vest, right?
Because they don't want to keep predicting this big market crash. It's just not going to come. At least, knock on wood, hasn't come yet, right? So let's have some fun. I know we did not talk about this ahead of time, but let's kind of off the cuff. What are you thinking for 26?
I have a tendency to look. I hate to say this because I'm the eternal optimist. I am. I'm that guy who will always find the silver lining in any situation. I don't think it's going to be a banner year. I do think it'll be positive. But I tend to lean towards these guys down here at the bottom. And I don't even like a couple of these companies, right? But I tend to think that they're going to be a little bit more accurate. I think we're going to be below historical averages this year. What really did it for me was the symposium that you and I went to, which we talked about, that said, hey, midterm elections, historically not good. I got to look back at history and say they tend to be volatile. People don't know what's going to happen. That being said, that same symposium said the year after a midterm election historically is a very, very good year. So my thought is, what a great time to keep buying, because I want to get in before the big upturn that I think is going to happen next year. So that's kind of my thought.
Yep. So I could go either way. I could give you the reason why we're going to have a big bull year. I can give you the reason why we won't.
And to full disclosure to the people who are listening or watching, we've had these discussions amongst the partners here every year. The last couple of years, you were the pessimist in the group. You were the one who thought
more so
that it was going to be a little bit lower, and you've been more accurate than the rest of us were most of the time.
So I think what's going to happen in 26. I think we're finally, because we're already starting to see it. Mm-hmm. We saw it kind of the last 3 months of the year, the last quarter for 2025. So I think that trend will continue, and that trend is to the point that you were kind of starting to make, that you were touching upon. I think we're going to start seeing a rotation away from the Magnificent Seven.
Agreed. Yeah.
And I think I'm going to be really, really impressed if this happens. But we talk about how much of the market has been up over the last couple of years. It really hasn't been a very widespread rally, because it's been so top
7 companies mostly, right?
It's been so top heavy, and yes, the Magnificent Seven is a big part of it, but specifically the tech sector. I would say the communications sector, but really that's just Google.
Yeah,
everybody else hasn't really participated. What you've really started to see in the second half of this year is a little bit more breadth in the market. And I think you're starting to see a rotation back into, because I think people are starting to realize not that these companies are bad, not that they're not, good companies and they don't deserve investments, but I think you're starting to see the better value on the value side, if you will, and in some of these other sectors that have been lagging behind. A lot of what I've been reading about is, yes, AI is part of this trade, but it's not so much about the AI companies that are creating the AI. It's about a lot of these other smaller companies that are now going to find ways to adopt the AI.
Yeah.
And as some of these smaller companies start to adopt AI into and really it's just technology. I kind of hate that term AI, because no one, but it's really
AI is part of technology, though. That's a better way of phrasing it.
But it's advanced technology, right? Yeah. And we're always getting advancements in technology. But as some of these smaller companies are starting to adopt AI into their practices. So let's take like logistics or supply chain companies, right? They're not tech companies, but they kind of are.
They kind of are,
because they need all this technology to analyze, the different solutions and how to move packages and move supplies and move things on up the chain, right? And I don't work in manufacturing, so I don't know enough about this, but I know enough to kind of.
But I would argue that you're right. All of these are very technology driven. The logistical supply chain, because, here in Louisville with UPS, we've got a lot of UPS employees that are clients of ours, and you hear a lot about what they do, and it's extremely technology driven. And I think AI is going to be a big part of that, because it's just simply going to make it more efficient. So those are tech companies in a way.
So I think we're going to see a rotation. I don't think we're going to see the performance that we've had over the last 3 years. I don't think we're going to see performance in the 20s of the S&P 500. I think probably somewhere around average, maybe above average. So let's say 10 to 15%.
I would love for you to be right.
I would love for me to be right too, but I don't know. And we'll come back and revisit this at the end of the year and see how wrong we both were. Right. And we're looking at another 20%. Return,
I'm hoping we're both wrong, because it was 25 or something. That would be great.
But I just fundamentally, anyway, I don't see the fundamentals behind a crash. I just do not see it coming.
Agreed.
Everybody's waiting for this crash to happen, because the earnings are overvalued, and it's not happening. Every time we have an earnings season, we're surprised to the upside, right?
True.
These companies are making money. The consumers are spending money. Everyone keeps talking about how limited the consumer is, and rates are too high, and no one can afford anything, and inflation's killed everything. You look at the data, that's not true. People are out there spending money. Go to restaurants. Go to nice restaurants on Friday, Saturday nights, and they're full.
True.
That's
a great way to gauge it.
Yeah, it's what's happening in your own neighborhood. We just got through Christmas season. Every time I drove by the mall.
There's another analogy. I love that. The mall and the restaurants are great. One just popped in my head. I don't know if you're familiar with a guy named Louis Grizzard. Now, Louis died 30 years ago. Humorist, very funny storyteller. And he had his own prediction for how good the economy was. You go out on a golf course and go out on the tee box. How many tees are laying on the tee box? If the economy's good, people aren't picking up their tees, right? Just put another one in next time. But if money's tight, if the economy's bad, everybody picks up their tee because you got to reuse it. Well, that being said, I didn't get to play that much in 2025, but every time I did, there were a lot of tees out on the tee box. So,
yeah, and maybe that's part of a greater discussion around who. Let's say the haves and the have-nots, and kind of the K-shaped economy, and we don't need to go down that road. But from a market perspective, people are still out there spending money.
Yes, they are.
Or at least enough people are out there still spending money, and they're spending it with the right companies, and the right companies are making money, and they're surpassing their earnings. So I just don't see the fundamentals of a crash. Now, of course, something could happen.
Sure.
Who knows? We're going to get new tariffs.
We talked about things that happened this year that there's no way we could have predicted.
Yeah, what's going to be
in 2025?
What's going to be the tariff story? The
who knows?
Venezuela story in 26. Nobody knows, right?
Right.
But that's kind of where I'm at right now. I would not be surprised if I'm totally wrong. To be very, very clear, because I'm always very upfront. We have this conversation with clients a lot. What do you think the market's going to do? I'm the first one to say I don't know.
I don't know.
Nobody knows. I
wish I had that crystal ball.
And if I was going to sit here and tell you I knew what was going to happen in the markets, then run. You don't want to work with me
exactly
because
right.
I'm lying to you. Nobody knows. I love. This is another side point, right? But I love whenever I hear clients talk about their advisors that told them, oh, this portfolio is designed to get you 6 to 8% return.
Mm-hmm.
No, it's not. No, it's not. Nobody knows. No one knows what kind of returns you're going to get because no one knows what the market's going to do. So anyway, that's another discussion for another time. So I'm maybe a little bit more bullish than you.
A little bit more, right.
But we both are kind of expecting another halfway decent year in the markets.
I don't think this is going to be a down year. I think this is going to be a great opportunity to put more money into the markets if you've got a long-term play. Because I think you're gonna win if you just keep buying in.
We talked about the midterm election. What's interesting is I thought I had this thought earlier and I meant to come back to it. I'll do it now. Because you said no one knows what's going to happen with the midterm elections,
right? And
maybe that hasn't been priced in. I think some of that is. I think most people kind of already know what's going to happen in the midterm elections. I think Republicans are about to get slaughtered for the most part.
Who knows?
I think most people kind of are expecting that. I don't know if there's really much mystery as far as what's going to happen in November. Maybe the final head count.
And let's be real honest. When you talk about it being baked in to the markets already, but historically, midterm is bad for the party that is in the White House.
Yes,
right. That's just historically that's the way it works. So
we'll see. We don't know. We don't know. But it'll be fun to watch.
Throw the Fed into that just to complicate everything.
Well, this is I'm very glad you brought that up because this kind of is another reason why I'm thinking maybe we will continue to be a little bit bullish.
I would agree with you on that. It's because interest rates dropping.
I mean, they're already predicting another 2-3 rate cuts.
Mm-hmm.
Now that might not be good for inflation, but that typically is going to be good for
It'll be good for stimulating the economy.
It'll be good for stimulating the economy, stimulating market returns, stimulating earnings reports, which is what the market cares about, right? So I do think that's another reason why I'm not too terribly bearish. I mean, Trump's written it and talked about it everywhere that he possibly can. He wants Jerome Powell out. He wants someone who's going to do his rate cuts in, and that's probably going to happen in 26.
Well, we know Powell will be out this year because his term is up. I don't believe that the administration has announced who the next person is going to be.
No.
We do know some people that they're talking about.
Yeah, and I've heard some. Yeah, basically they're all Trump guys, right? That are
probably I understand that. Yeah.
So, but we'll see. And I'm going to pour myself another.
So that actually leads us into the next part of our conversation, which is the bourbon. And I was going to ask you. So what do you think? And then I looked over and I noticed your glass was almost empty. And then you grabbed the bottle and went for another pour. So I already know.
Yeah, no, this is
at
good.
a high level what you think.
This is really good.
It's really good.
I'm not even going to water it down. I don't need to.
You know, I did put a few drops of water in it. What I tasted, and we've had this discussion about our palates, what I tasted before I cut it with a little bit of water, heavy caramel. I tasted a lot of toffee, some butterscotch. Yeah. When I put the water in, I lost the toffee and the caramel. It's still there, but it's very muted. It truly did water it down, right? It didn't bring out any new flavors. It just kind of watered it down. So, in the spirit of enjoying something that is at its better form, I'm going to pour a little bit more too.
But yeah, this is, I mean, so how long did you put it back into the barrel?
I'm going to tell you the wrong thing. I know some of the guys are going to listen to this and they are going to give me 40 kinds of hell. Yeah. But I want to say it was somewhere between 6 and 8 months. We did this back in the summer, I think. But it all blurs together because understand that at any given time, there's 3 or 4 different barrels out there in that barn that are aging something. And I was not there when we actually pulled it out and bottled everything. So I think
this is good.
It's really good. Okay, full disclosure, Maker's Mark is a wheated bourbon. So it tends to be softer on the palate anyway. The Maker's Mark Cask Strength is a great product.
Great pour,
we have done that on this show before. We did the newer version where they're actually putting an age statement of 7 years and 6 months on it, and we loved it. All we've done here is basically double oaked it. Yeah. You know, just a secondary aging of it, and you're right. It was fantastic. What was neat was just...
It's definitely richer than...
Yes, it is very much so. And we've done double oaks before. You know, you're a huge fan of Woodford Double Oak. We've done the double doubles from Old Forester and Woodford Reserve. They're all wonderful. Just to let you know the process that this goes through. So we lost 50% to evaporation, if I remember correctly. Wow. We lost a lot.
Yeah, that's common.
Now, part of that was we had a very, very hot July. So it was cooking out there. I know we did it before July because I remember that. The way that you do it is you buy more bottles than will fit into the barrel as you are sampling it, because you know pretty much every week you'd take a small pour out of it, see what it's doing, see what it tastes like, see what's changing, and then as between the sampling and the evaporation, you know, causing it to go down, then you would pour more in there. So there's some of the juice that came out of that barrel that was only in there for say a month. Whereas other stuff would have been in there the whole time. So it's not that the whole thing goes in there and you leave it closed and you pray. That's not the way you do this. It's a constant experiment. Sometimes it doesn't come out as well as you hope. But you know what? It's a lot of fun to experiment around with this. And just to keep the cost down, because one of those barrels can cost you, you know, $100, $120 plus all the bottles that you have to put into it. That's where you get a group of people together and everybody pitches in $30, $40, $50, $100, whatever you want to do. Yeah. And then you get to do an experiment together, and it's a lot of fun.
If anyone's watching on YouTube and they see me like moving around, we're like...
I was going to go to that next. I thought that would be important.
We're in our new, you know, podcast room, our new studio at the new office, and this is a little bit different than our old setup in that we are, you know...
Well, in our old setup, we had glass on the side where I always stood, but we had blinds that blocked it. Yeah. And then we had one little slit of a window in the door, so we couldn't really see. In this new one, behind the camera is wall-to-wall glass. We're looking out into the parking lot, and over to our left is all glass, so when clients come in, they can see us in here recording.
Yeah, our reception area is right over there. So,
And because there are still contractors here working, it has been a constant flow of people. It's so you're going to see our eyes flickering around just watching all the different chaos. There's actually a miter saw and a planer out on our sidewalk right now because the guy's working on some of the framing work. So it's very chaotic around here, and it's a little distracting, but I am so loving the light that we've got and the big space that we've got. And I can't wait until we get all the little pieces where they're supposed to be and some great signage up on the wall. And I think you got a great idea. We'll do an episode on the new office and our branding and why we do what we do.
Yep, we'll definitely come back to that.
And we might have to drink more of this when we do it, because this is outstanding.
You can bring this one.
This is outstanding
back in.
stuff.
This is really, really good. I like this one. So.
Good stuff. So let's wrap it up.
Well, thanks for joining us on our premiere episode here at the new office. We'll be showing off a little bit more of it over the coming weeks and months, but we appreciate you joining us, and we love having the opportunity to talk to you all about what we do for a living, right, and the financial services and investment space. So if anyone has questions about retirement planning, investments, anything related to your individual portfolio or any of your family members, we would love to discuss that with you in any level of detail that you would like. Please go to our website, fwppartners.com, schedule directly from the link in the right-hand corner. Give us a call. We would love to chat with you. Thanks for joining us. Until next time.